Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Ying Wang, Head of North Asia, Property, Industrials, Consumer, and Utilities at Fitch Ratings. Today, I'm very pleased to introduce my colleague Sam Kwok, Senior Director and Head of APAC International Public Finance at Fitch Ratings. Sam joined Fitch in 2017, and he is based in Hong Kong. He leads a team of 25 analysts covering the APAC public finance sector. The team's biggest portfolio is in China, which covers around 150 publicly rated entities, so-called local government financing vehicles, or LGFVs in short. They are important platforms to raise financing and carry out policy roles for Chinese local governments. Chinese LGFVs have incurred a significant amount of debt over the past 15 years, and have become a focal point in recent years, posing risk on the country's financial and economic stability. Sam's team has closely followed the sector's regulatory and credit development, and in today's podcast, we will get to hear his team's latest thoughts on the sector. Hi, Sam. Thank you very much for taking the time to join the podcast. At the beginning of this year, your team published a neutral credit outlook on China's LGFV sector. I read the report, and it highlighted that your team is expecting a modest recovery in Chinese local government's operating revenue, which will partially offset a continued decline in capital revenue, which is mainly composed of land recession. And this is because of this prolonged downturn in the Chinese property market. At the same time, local government's capital expenditures are going to be mainly funded by an increasing load of local government bond issuance. Now we are in August, so looking back at the past 6 or 7 months, did the local government's actual performance come in line with your expectation? Were there any key trends that you observed and would like to highlight to us?
Sure. Thank you, Ying, for inviting me, first of all. So I think in terms of the trend for the first half, it's been largely in line with Fitch's expectations. While we've seen some signs of stabilization, it's important to note that challenges still remain. For local regional governments, or we call them LRGs, the fiscal budget has 3 major components: revenue, expenditure, and debt. So let's start with revenue, right? So operating revenue has been relatively flat during the first half of 2024. However, a closer look reveals that the tax revenue fell by close to 6% on a year-on-year basis. From our conversations with many LRGs, it seems that this lower pace of recovery seems to be the norm across the country. The second important source of revenue was capital revenue, which fell 17% on a year-on-year basis. Now, given the state of the property market in China, this wasn't sort of a big surprise. So moving on to sort of expenditures, the trend is quite moving in tandem with the revenue growth trend. For example, during the first half of 2024, the LRG's capital expenditures fell by around 18% on a year-on-year basis, which is quite similar to the decline we saw in capital revenue. Now, lastly, let's talk about debt. So new issuance was down 33% on a year-on-year basis. We believe this decline is likely due to slower growth in capital expenditures, as well as additional funding coming from the central government, say in the form of special purpose bonds.
Thanks, Sam. So what's your expectation on the second half of this year? Do you think that local government's fiscal performance will improve in the second half?
Yep. I think, as we move into the second half of 2024, we do expect marginal improvements in terms of revenue. Specifically, we anticipate that operating revenue will see perhaps a modest growth. In the first half of 2023, these LRGs collected some revenue in arrears. So the high base effect that we saw then is expected to sort of fade in the second half of 2024. Now, regarding sort of capital revenue, we believe that, a significant recovery is highly unlikely. However, it's important to note that capital revenue is subject to some seasonality. Traditionally, the first half of the year accounts for roughly 1/3 of the annual total. So therefore, we wouldn't be surprised if, say, the decline in capital revenue narrows as we progress throughout the year. Now, that said, the ability for LRGs to ramp up capital expenditures will be significantly constrained by the trend in capital revenue. Under China's fiscal budget rules, revenue plus debt must equal expenditures. So if revenue declines, expenditures must also decline, assuming that there's no increase in debt.
Okay. Last year, the Chinese government identified 12 Chinese provinces as high-risk regions because they had significantly higher debt levels relative to their economic output. And these regions had weaker economic growth and therefore higher reliance on central government transfers. It's been about a year since I think the Chinese government started to implement measures to contain local government debt risk. Can you talk about the measures that you have come across taken by the Chinese government to contain the risk in these high-risk regions? And do you think that these measures have been effective so far?
Yeah, of course. Based on sort of media reports, these so-called 12 provinces in China have been asked to either postpone or even suspend some of these infrastructure projects. There have been many questions in the past in terms of, questions about the future economic returns of these debt-funded infrastructure construction, right? So now we believe that this marks a shift in how sort of the central government is managing debt risk. Now, the central government has also announced some support measures targeting these regions. An example would be sort of the special refinancing bonds. Now, under this scheme, provincial governments will issue special purpose bonds with the proceeds given to LGFVs, or what we call local government financing vehicles, to repay their hidden debt. Now here, the hidden debt refers to debt that were previously raised by LGFVs to fund policy projects that do not generate any cash flows. Now, this scheme is not entirely new. In fact, quite similar to sort of the debt swap programs that we've seen in the past. Now, Fitch believes that these measures have sort of reduced the short-term refinancing risks for LGFVs in those regions. Prior to the scheme, a lot of these LGFVs were facing difficulties or challenges, in terms of refinancing. So a lot of these LGFVs were only able to issue bonds with very short tenors and at a relatively high cost. It's important to note that under sort of the debt swap, the LRGs have replaced higher cost LGFV debt with cheaper direct debt or government bonds. So essentially, the aggregate debt between the LRGs and the LGFVs remains the same. Now, consequently, so repayment of these debt, the LRG level or LGFV level, will continue to rely on the economic growth of these regions, which potentially could be facing challenges in terms of a slow recovery.
I think one highly visible effect of the Chinese government's measures to contain local government debt risk is that the Chinese LGFVs onshore credit spreads have narrowed significantly over the past 12 months. And together with the Chinese central government's benchmark interest rate cut, the LGFV bond yields have reached record lows. What do you think that sector has been materially de-risked?
Well, I think, in terms of the credit spreads, they have indeed narrowed considerably, driven by sort of improved sentiment, investor sentiment, I should say. However, I think as you pointed out, Ying, the benchmark rates have also played, a role in this trend. So it's difficult to sort of separate the impact of these two factors. But what we've seen is that the general funding conditions for the sector have improved. So let me give you an example. So one of our rated LGFV issuers within our portfolio was able to issue an ultra-long bond with a tenor of 20 years at a very low coupon rate. Now, before some of these measures, a lot of these LGFVs were only able to issue, 1 year, 3 year, 5 year bonds. So this was sort of a change. Now, sort of this trend really started at the end of towards the end of 2023. following the central government's announcement of some support measures for the sector. Now, these measures included, say, the special sovereign bonds to help LRGs with expenditures, as well as refinancing bonds that we discussed a little bit earlier. Now, Fitch believes that these measures are aimed at more at preventing systemic risk than serving a full-scale bailout. Now, as of end of, say, May 2024, about 27 provinces have issued about, I would say, 1.5 trillion roughly in the CNY in special refinancing bonds. But if you look at that amount, it's far from covering sort of the total outstanding LGFV debt. So another factor that sort of contributed to sort of the improved investor sentiment is the government's influence over sort of the financial institutions. I think LGFVs in the past year, they've been encouraged to sort of renegotiate with banks and, other FIs to sort of lower their interest rates on their loans and to extend the loan tenors. Depending on some region, I think, some LGs are even requiring their LGFVs to replace non-standardized financing, so which typically carries higher financing costs with lower cost bank debt.
Okay, Sam, so what would be your top 3 credit themes to highlight in the Chinese LGFV sector over the next 12 months?
Yeah. So we think, one of the top theme is we do sort of expect upper government support to continue. Essentially, we expect sort of the central government will cover a bigger share of the total expenditures. Now, this support could come in the form of, say, central transfers, a continuation of some form of debt swaps. So we'll be sort of also closely monitoring sort of the details following the Third Plenum, particularly in, whether there are going to be changes in terms of the allocation of revenues or a higher percentage of revenues given to LRGs.
Yeah, since you mentioned the Third Plenum, we know that the Third Plenum did pledge to increase local governments' tax revenue and central transfer to alleviate their local fiscal imbalances. So what's your expectation on the potential credit impact of these sort of tax reform measures and also increase central transfers on local government finances?
Yeah, so that was sort of a focus during the Third Plenum, but we want to emphasize that it's more sort of medium term in nature, right? So I think as of now, we're not sort of expecting sort of immediate credit impact. Now, I think as you sort of pointed out, I think a lot of these LRGs, historically, they receive only about 60% of their total revenue, but are responsible for close to 90% of the expenditures. So this sort of imbalance has led to LRGs increasing their leverage. Now, during the Third Plenum, the central government did signal sort of potential for increasing the revenue allocation to LRGs, as I mentioned earlier. I think there are no sort of further details regarding to the exact reform at this time. So we think ultimately the net credit impact will really depend on whether the overall size of the revenue increases, so a bigger pie, or simply a reallocation of revenue between central and local governments. Nevertheless, we do expect a higher revenue will sort of improve the overall flexibility of LRGs. Now, if LRGs receive a bigger portion of, say, locally generated taxes, such as VATs, this may incentivize them to focus more on, say, domestic consumption rather than sort of the traditional infrastructure-led GDP growth.
Okay, what about the other 2 credit themes?
Yeah, so I think the second key theme that we're going to be looking at is going to be social housing, which has been a hot topic recently. There have been a number of media reports suggesting LRGs likely going to be increasing social housing supply. Now, local governments can achieve this by either sort of constructing new housing themselves or possibly purchasing existing property projects from developers and converting them into social housing. Now, there are also reports that the central government is considering allowing local governments to use special purpose bonds to finance these purchases. So the big questions that we're going to be looking at will be how much this is going to cost the LRGs, how will they fund it, and whether this is going to add to their physical burdens. So I think finally, the third theme that we're going to be looking for is the LGFV debt growth restrictions. So we talked about the support measures in 2023. It also came at a price for LGFVs in terms of implementing additional restriction on debt growth for LGFVs. So specifically, many LGFVs, which were classified as sort of financing vehicles or platforms, or have difficulties obtaining new debt, perhaps only able to refinance existing debt. Now, in fact, we've observed that LGFV's net financing growth has slowed to single digits, right, from double digits from before. And some of these regions even sort of experience year-on-year decline as of end of 2023. Now, if these funding restrictions become too tight, this may sort of raise concern over sort of the potential liquidity of LGFVs, considering their policy mandates to increase investments. Now, additionally, some LGFVs have been seeking sort of to reclassify themselves as no longer being financing vehicles, maybe possibly as a mean to raise new debt. Depending on sort of the outcome, this could potentially pose a challenge to the government's measures aimed at restricting debt growth.
Against the backdrop of these three major credit themes to watch out for, do you still maintain a neutral outlook on a sector?
Yes. So I think in our sort of original outlook of a neutral outlook, we were expecting things to stabilize and then perhaps with some sort of modest improvement. So I think it's been largely within expectations so far. We saw from sort of the support measures that we've seen from the central government, this has also sort of resulted in a credit spreads narrowing and sort of a general improvement in the funding conditions for the LGFV sector. So I think from a trend perspective, we're not expecting things to materially worsen at this point, and hence, so sticking with the neutral outlook here. Thank you, Yang.
Thank you very much. Thank you very much, Sam, for joining us. And that concludes our podcast today. You have been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Please subscribe to iTunes, Spotify, or wherever you get your podcast. Take care until next time.